for us at Better Dwelling, we're really into the research that you're doing in regards to the housing market, credit dependency, and all of the things related to that. But quickly, for those who don't know who you are, the research that you're doing, could you give us a quick introduction of your role and your area of interest?
Absolutely. So my name is Enrique Martínez-García. I'll start with the very basics. And my name, and I'm a senior research economist and policy advisor. So I've been in Dallas since 2007, occupying different roles, but usually within what we call the Globalization Institute, which is part of the research department and part of an effort by the Dallas Fed to try to challenge the old-fashioned idea that the U.S. is essentially, and for all intensive purposes, a closed economy. And as part of this, arriving in 2007, I got quite interested in housing, not just because of the major consequences of the housing crisis of 2007 for the U.S. economy, but also because of how interesting, from a researcher's point of view, of course, it was to see the degree of concordance and or similarity in these episodes of housing booms preceding the crisis and crisis afterwards in many other countries. So I've been spending quite a bit of time since those early days trying to figure out what are the lessons that we could learn and how can we be better prepared for the next time.
Okay.
And that's sort of in a nutshell a bit introduction to myself.
Awesome. Yeah, I really appreciate the introduction. And I guess it's interesting in this point in time right now because the average consumer obviously knows the role of the Federal Reserve probably better than ever, right? In regards to control over interest rates, the role in trying to curb inflation. And a lot of this is around probably the involvement that individual consumers have had in assets over the pandemic, I think, blocking into different assets that stocks, cryptocurrency, real estate being a big one. And the rate dependency now is becoming apparent as we get to the other side of that pandemic monetary policy. How much of an impact do interest rates have on home pricing? And is there a clear correlation that's visible in data? And how do you describe that to the layperson with the research that you're doing, but also, with the language that you use to sort of describe the phenomenon?
Absolutely. Very interesting question. So economists would tell you that that housing is a particularly interest rate sensitive sector. And I guess it's easy to see right now, or at least since the early 2020, since the early days of the year 2022, how much of a sensitiveness there is in the market. Loan origination, mortgage loan origination fell very significantly in the U.S. and across the board, I would say, as the Federal Reserve and other major central banks started to tighten monetary policy. But describing that sort of empirical relationship between rates or interest rates and mortgage rates and house prices is part of the story, the impact is determined by the mechanisms that explain that sort of relationship. And I think I would highlight three things. From an investor's point of view, so if you think of somebody that is putting their money on a housing and expecting a future return, higher interest rates imposes a higher opportunity cost. So in other words, for them to be willing to pay the same amount of money for the house today, they would have to secure a larger stream of payoffs in the future. That, in terms of housing, is another word for higher rents. And that might not be what happens. In fact, right now we are in a situation where the the moderation in house prices or the cooling off in house prices, not just in the US, but in many other economies like Canada, is expected to lead to also a very significant slowdown in rents. So you are in a scenario where you have lower rents and higher interest rates. So that sort of pushes out the investor type from the market. Then the other two things that I believe is important to mention is interest rates are a very important component of affordability. Another big part of the market is determined or related to household formation or households moving up the ladder or changing across their lifetime their household needs. All of that has to be financed with, in part, the possibilities of the household in terms of disposable income, but access to credit and how expensive this credit is going to be a very important factor. And now we're in a situation where many countries are seeing historically high price-to-income ratios, where income is defined as personal disposable income net of taxes, and at the same time, very rapidly increasing mortgage rates in response to the tightening of monetary policy. So that's detracting from the demand of housing for household formation right now. And it's very much connected to the ability to finance those purchases. And then there is a third component that should not be underestimated, which is that developers, when they purchase land and where they develop new projects, also need to be financed. And that is becoming more expensive in an environment of quickly slowing down prices. So that's actually starting to hinder supply as well. So all those are the three main channels through which interest rates will have an impact on the market.
Interesting. And the development element is something I'd actually really like to think about here just quickly, because I don't want to get too micro on you, but does that what you're describing there, the disincentive for developers to create housing supply because the economics of it are fundamentally destroyed for a short period of time, does that create a bit of a gap a couple of years out during maybe the recovery phase of the economic cycle that we're going through, where we're actually undersupplied and there's actually almost a little bit more of an expedited recovery? Because you hear a lot of people who want to be bullish, let's say, on housing and the recovery of it after we get through the trough of the recovery, saying that this undersupply is actually going to create an excess demand scenario, or is it too small of an impact to really think about it in that way?
No, that's a very interesting thing. And I think you are hinting at something that is very important, and it is that, and I should have probably been more clear on this, is that there are lags on how these things impact the housing market. So I'm going to make a related argument based on the evidence for the US. In the US, we actually have evidence that the amount of houses, completed houses, new houses in the market during the pandemic was at record lows. Inventory was very, very low. But during the pandemic, we had this very rapid appreciation in house prices, and that stimulated, that had an effect of stimulating the supply. So we actually find ourselves that the amount of houses not completed or not started already up for sale in the market by the middle of 2022 were at essentially their historical highs or very close to historically high levels, almost comparable to the highs that we saw during the pandemic. So there is time since the development gets started until fully completed houses get into the market. The response of the supply right now to the higher interest rates might be to pull back for a little bit. But that doesn't solve the problem that there is essentially a very large amount of houses that have already been started or committed, putting downward pressure on the market right now. So over the medium term, and getting closer to the spirit of your question, over the medium term, I think it's going to be fundamental. At its core, big recessions or big contractions in housing are going to be ultimately driven or impacted by the decisions on the margin of households. And these are going to depend very critically on things like what happens in this tightening cycle of monetary policy with the strength of the economy and the unemployment rate. So if it is the case that the unemployment rate increases a bit, but moderately by historical standards, and that growth is weak, below 10 perhaps, but we don't get into a full-fledged recession. So it's easy to see, at least in markets like the US, that house prices might start to I don't want to say pick up in the sense of growing at the rates that we've seen over the past 2 years, but they start to show positive gains in 1 or 2 years.
Right.
The strength of the household formation will be decisive on what sustains the market or not. And if housing formation it's hit very badly for whatever reason, so we can get into that later perhaps, then we should not underestimate the possibility that the correction is much higher or much more severe.
Yeah, so you mentioned during, I think, like the when I had originally talked about the impact of interest rate on house prices, you were describing a little bit about rental rates coming down and capital costs going up in unison, and how that would sort of destroy investment thesis for investors. But another portion, I think, of how we get to this phase where housing is in having a complicated relationship economically, is really from the speculative element, right? And that's very much fueled by interest rates, right? By cheap capital. How do you reconcile for the credit contraction and the role that it plays? And like, do you get, Canada being a good example that you use when you're talking about the investment fundamentals, but also the US, do you get the sense that this, excessively affordable capital and debt and has fueled almost states of mania, or is there fear that there are real estate or housing bubbles forming even in the micro or in individualized markets in different places in the world, the Commonwealth being an exceptionally maybe low-hanging fruit for discussion?
Look, that's a very good question. Like all the ones that you've given me so far, the reality is that all the signs point. I'm going to start talking about the U.S. experience and then speak a little bit more about the international experience and perhaps Canada as well. The reality is that 2020 was a very unusual year for the housing market. And not just for the housing market, obviously, because of the impact of the pandemic. So there were reasons why you would expect house prices to outpace their historical norm at that point in time. You had, on the one hand, extraordinarily low, historically low interest rates, sparked as a result of deliberate policy of monetary policy accommodation to try to prop up the economy in those difficult times. You had very large packages of fiscal stimulus that had a very direct impact on disposable income of households. You had trends that have significantly accelerated during the pandemic, like migration patterns across the states within the U.S. and search of the impact, I should say, of work from home arrangements on the housing market and the location of households, that has had definitely an impact on certain local markets. So that was happening at a time where lockdowns and restrictions made it very difficult for construction to keep going and to keep up with that demand. So early on, there was a fundamental cause for it. But at the end, I should say, probably by 2021, we were already seeing signs that housing supply was picking up. The strength of the demand was not particularly more dynamic or more robust than it had been in 2020, and yet at the same time, we were seeing prices continuously accelerating. What I'm trying to get at is fundamentally the drivers of the market by 2021 were driven by expectations. And this has behavioral reasons, and this is explained by cheap money to a great extent, as you hinted at. The term that we usually prefer to talk about this is FOMO, fear of missing out. This idea that you have,
is that the technical term?
These great opportunities. I'll call it a technical term if you allow me to.
Yeah, I love that for sure.
But it's part of the of what was happening at the time. Everybody was convinced that in an environment of very low interest rates, with very little opportunities for return elsewhere, housing was where you wanted to be if you wanted to get a great return. And the evidence is that this was happening in the US. This might have been happening already in places like Canada even before the pandemic, but the pandemic, if anything, might have reignited the desire to get into housing and to take on those opportunities. So from our perspective, the evidence in the data was already quite robust, pointing out that something was overheating in the housing market, and that it did not look like, in most cases, fundamentals could explain why. It had to be expectations about these future gains continuing over time, which were becoming, however, out of sync with the fundamentals of the market themselves.
Yeah, very interesting insight. I might pick on Canada a little bit as well, just because that is where our publication is based. But and kind of try and use a couple of different anecdotes and examples, but also like the data. So Canada and Toronto especially, there were two kind of counter cycles happening. One in Vancouver as a result of non-resident speculation tax starting in 2016 as that market rolled over. 2017, the same thing happened in the Greater Toronto Area. And both those markets were very much trading sideways and kind of starting to look like they were getting into a recovery phase just before COVID. But I think from a psychology perspective, it almost felt like consumers saw that the pandemic couldn't destroy the housing market, because there was a pause at the beginning of the pandemic, and a lot of it was because of lockdowns. We literally couldn't trade real estate, but also because I think if you look back at the history of sales volume in Canada, 2008 there was a big dip in volume. Canadians seem to respond to uncertainty, financial uncertainty, by pausing everything that they're doing and waiting to see what other people do. And and then I think the emergency monetary policy rates came into effect, and the market appeared resilient to the pandemic, and it just gave this sense of invincibility to the Canadian housing consumer. And that seemed to be echoed across a lot of different places in the world. What started to happen, I think, as a consequence of that in Canada and in a lot of different markets, when you talk about, the global phenomena of sort of the frothiness that was beginning to happen, was as prices climbed, more and more people were extending what they their credit requirement to get into the market. So in Canada, we saw co-signing till you could qualify for a mortgage, right? Bring your mom and dad on. Borrowing till you could qualify for a mortgage. Committing fraud in some cases for shelter to qualify. Anything to capitalize on the market and get away from that FOMO that you mentioned, the fear of missing out, by any means necessary. And you know, in regards to, because you mentioned a couple of times how what we're going through right now is different than the past, the real housing bubble that happened in the States. You know, a great biopic on that topic is the Big Short, and it starts with a quote from Michael Burry that says, you know, one of the hallmarks of mania is the rapid increase and the sophistication and occurrence of fraud. I think is something, and in Canada we're seeing a lot of mortgage fraud, a lot of do-it-yourself stuff, but fraud for shelter very much in both the rental side and the ownership side. Is what Canada is going through, you know, on a much smaller scale, do you think similar to what the U.S. experienced? And then, so that's kind of question number one. And question number two is, you know, when you say that in the unwinding of the market that we're seeing now is different from the States, why is it different? What makes it different? You know, if we're able to build some comfort for the average person looking at maybe the second major housing correction that they've seen in their lifetime, why is this different than 08? I would agree with you, but you know, and a lot of it's structural changes in the States, but is Canada similar there? And then what is different in the States?
That's a very deep question, and I'm going to try to answer all of it, but please feel free to interject and let me know if I'm missing some of the things that you raised.
Sure.
I think you're raising some very important points. In the U.S., in particular in the States, there is some evidence that since about 2009, 2010, loan origination was occurring at a much lower rate relative to the rates that we were seeing at the time than the historical precedent prior to the housing crisis in 2008. And this is in part because banks got hit very badly. They adopted perhaps more conservative practices, and there were regulation changes that forced them to impose some stricter practices. During the pandemic boom, we saw a significant increase, almost a doubling of loan origination. But what's interesting is that most of it went into fixed rate mortgages rather than variable or adjustable rate mortgages, which was one of the things that happened in the early to mid 2000s in the US, with facilitated in part by the financialization of the mortgage industry at the time. So what's significant about this, and by the way, part of the volume of mortgages that we see during 2020 and 2021, it was actually people taking advantage of the historically low mortgage rates of 3.25 percentage points and refinancing. All of that obviously is gone, and now we have a very significant decline in mortgages as mortgage rates have been hovering between around 6.5%, 7% in the States. So one of the things that we believe, or why we believe the situation is different this time, is because loan origination and the quality of the loans appears to be stronger than it was in 2005, 2006, 2007. That means that the financial institutions probably are in a better shape to withstand a correction in the housing market if one were to occur. The other reason why people have some confidence that the baseline scenario for the housing market in the next couple of years, 3 years, is that of a mild correction in 2023 and perhaps starting to pick up by late 2023, 2024, is because we do think that the impacts of housing itself are less severe when they did not come associated with a very large credit boom, at least not to the extent that it was before 2008, and when the financial institutions themselves are in a better position to keep making loans. Because one of the things that we believe made the 2008 crisis worse and made the impact of housing have far-reaching consequences over economic activity in the U.S. is precisely the fact that financial institutions were hit very hard, and that affected credit broadly for the entire economy, not just for the housing sector. That withdrawal of credit had an impact on overall economic activity. In terms of Canada, Canada is a very interesting example. There are some key major cities, as you well know, and then the rest of the country. And these key major cities are or have behaved in ways that, although not identical, they do resemble, to me, some of the experiences that we saw in the previous housing boom in the East Coast and the West Coast of the U.S. This is just a pure anecdote and is based on local data for the U.S., but there were even trips organized by foreign investors, Japanese and Chinese investors, coming to Dallas or mostly to Austin to buy real estate. They were able to borrow long at very short rates and come to the U.S. and make an investment. I do believe that this global financial cycle of easy money has had a particular direct impact on some of the largest cities in the U.S., as well as in places like Toronto, Vancouver, that we were talking about. Now, the situation in Canada, and you might be able to tell me more about this, is a bit more complicated because of household indebtedness. And I think you pointed out something that is critical when you say things like the financialization of credit, which is another way of trying to share risks to allow for higher risk undertakings. And fraud are signs consistent with investors trying to get around FOMO, but also households facing what is historically very unaffordable housing market. I don't want to sound perhaps too strong on this. You might know the details of the market better than me, but the situation is, if you look at the pure numbers, prices and disposable income, this is like historically high relative to where we were in the 90s, even in the early 2000s, in places like Canada.
Yeah, so every market in Canada has surpassed its unaffordability of 1989, which was sort of, to be honest with you, kind of the last peak of the Canadian housing market. It was followed by the 1990s recession, which I think was a lot worse for Canada than it was for the U.S. But 1981 would be the real big outlier, and that was when we saw those extreme hiking cycles into the 18 to 20% overnight rate in Canada. And we are now, some markets like Toronto being a good example, has actually exceeded its 1981 levels of unaffordability. Vancouver is still lagging a little bit, but I mean, we've blown, other than Calgary, we've blown 1989 out of the water. 1981 is what we're approaching. And to me, those are very scary figures. You talk about the household indebtedness. The other part that, from my perspective, creates something to be really fearful of is the longevity of the impacts of credit being, I mean, I personally don't think we're ever getting back to the interest rates that we saw during emergency monetary policy during COVID. And I think many people would agree with that. In Canada, during the U.S. For the past 2 years, people were taking on mortgages at low rates on 30-year fixed terms. They were winning the mortgage lottery. Like, they don't have an incentive to sell that house because they're saving hundreds of thousands of dollars over the course of their mortgage amortization. In Canada, we have this very and in much of the Commonwealth, there's two kind of distinct problems from my perspective that are worth thinking about. And one is it's an oligopolistic banking system, which is resilient, and it creates a degree of like lack of systemic risk. But it also, when you get to a point where credit contracts and credit becomes less available, it's very easy for credit to just completely constrict and the market to say, no, there's not much lending happening. But the other piece is that functionally, even our best loans in the market, if you got a 5-year fixed mortgage rate at the best rate possible during COVID, and you even got a good place on a good price on the home, you still have to renew that in 5 years, and there's no way you're doing it at that rate that you purchased at. And so we have this, even if you were to say, okay, average mortgage term in Canada is 5 years, so you've got every year you've got 1/5 of the market renewing a mortgage, right? Nobody is renewing at a rate that they originally got at in the past 5 years, and so not only the variable rates who are feeling the impact of the increased capital costs on a daily basis as those rates get wrenched up, but also we would call it an adjustable rate. It's functionally very similar to an adjustable rate in the States. Those individuals are going to be hitting those gates as their first mortgage term, their 5-year mortgage term comes up. And so I guess one is, it's kind of a thought that I'm just trying to outline to you, but does this mean that, from a recovery perspective, it can take, my thought is this means that Canada's housing market is going to experience a very long bottom period. I actually think that's a healthy thing. It means that people can trade in and out of the market safely. It means that we don't worry about big gaps between if you bought your house in February and sold the other house in March or April, that there's a $500,000 gap in your net worth, or you created all of this risk because of volatility. But like, does that check out with the recovery or the trough of the Canadian housing market being a lot longer than, or a lot more drawn out than a place like the US? But also, is this sort of like getting to the end of this, downward trajectory that we've seen in interest rates for the past 20 some odd years, and especially in Canada since 2008? Is this kind of like a sobriety phase of, partying for a long time, creating this huge addiction to credit, and now we're kind of in a new paradigm of an economy for the next decade? Or like, how do you set the expectation for homeowners, for potential home buyers, for real estate investors in regards to the new world of interest rates for the next 10 to 20 years, as an example?
And that's a very difficult question. So this is where probably we should introduce the word uncertainty. There is going to be a great deal of uncertainty at those longer horizons.
Yeah.
However, the scenario that you are laying out is quite consistent with my current thinking about what the baseline for the medium-term housing market might be. In the U.S., the impacts might be less protracted because of the types of mortgages that dominate the market. But a drawn-out process of correction might be in store even for the U.S. We actually don't even think that it's unreasonable to expect that the historical norm of having like around 4% adjusted in real terms growth in house prices that we saw prior to the 2008 crisis is going to be achieved over the next 10 years. And part of it is simply because, so we've talked about the possibility or the estimation that part of the price appreciation that we've seen during the pandemic was driven by a bubble in housing. And that is very much related to investors' decisions and to some extent households' decisions and their expectations about where the market is going to go. But, the reality is that even if you undo some of those excesses in the next year or 2 years, we are still seeing a housing market in the US and I think in Canada that is historically very unaffordable. In an environment in which interest rates, the most likely scenario is that we will not see a return to the very low, historically low interest rates that we've seen during the pandemic. So you should anticipate that over a sustained period of time, interest rates are not going to be as cheap as they are right now. And that has a hit on household formation. The only way you are going to be able to get back the market is if housing affordability improves. And that doesn't depend only exclusively on what happens on the demand side. There are things that over the long term can help is supply constraints and facilitate the accommodation of the population growth and immigration that the US and Canada are seeing. But in order to have a healthy market, probably you are going to have to anticipate that affordability, the indicators of affordability are going to have to improve over the next 10 years. And that requires that at the very least, that you have house prices not outpacing disposable income and the service payments on debt not increasing significantly for households. So some adjustment would be necessary no matter what, even after correcting some of the excesses of the past 2 years.
So in that, and I'll use this as kind of a last question here to wrap up, just to stay on topic. I'd love to revisit this with you in the future as well, kind of just to see, a play-by-play as things start to change in the market. But so a couple of different things. If we see a contraction in household formation, a lot of people indicate that, immigration, as an example, is capable of keeping the housing market in excess demand. And you mentioned, the population growth through immigration in the US, but also in Canada, where proportionately, we just set 2 records in Q1 or Q2 and Q3, plus an annual record last year in Canada for processing of immigration. The reality is, at least from my perspective, house prices are measured in dollars, not in immigrants, as an example. Right. And so I would say that those individuals still need money to purchase a house. And if we're experiencing credit contraction, then it can't necessarily grow the market unless everybody who's immigrating to Canada is coming with a massive bag of cash and you're not using any credit to purchase a home. But also because people come here to immigrate to Canada, they want to get a job, right? And they want to pay for their home. And so as long as this wage price disparity exists, fundamentally, we can't actually see any real growth unless everybody who's immigrating is getting an exceptional job, or there's some sort of outlier effect that I'm not aware of that's happening, which just doesn't make sense to happen at the scale of 400,000 immigrants per year, let's say. In 1989 was the last time actually that we set an immigration record in Canada. So I think, history shows us that it's not necessarily going to save the housing market, but I guess my question is, how much can we actually rely on in the States? I know that there's evidence that you'll experience a housing shortage for your population over the next decade. And in Canada, it's certain that we are already in a massive housing shortage, and that's only going to perpetuate as we have more and more people entering the Canadian economy and looking for houses and starting new household formation potentially. How much can we rely on this effect to keep us in a state of excess demand and maybe not drive prices up, but at least floor prices or protect against the downside risk over the next 5 years? And is the effect of something like immigration or population growth, which really is only happening, at least in Canada, from immigration? I think we have the lowest birth rate proportionally we've had in ever. Is this a reliable bull case, I guess, is the question that I'm trying to ask here, right?
I mean, we've talked about a number of the fundamental forces at play here, and population growth, demographics, and things like the migration are fundamental factors. So that would give us for a whole conversation that would be very interesting. A long story short is, I think you hit the key point here when you tied it to essentially what amounts to affordability. So all this immigration might be adding strength to the demand, but it's also a contributing factor to the overheating the housing market. And there is a point at which this housing market is going to start becoming just too expensive for these immigrants, and becoming potentially a cause for a slowdown of the immigration process. I want to say this, to put this more broadly, if you allow me to. I think people, not everybody, of course, but may underestimate how central housing it is for a lot of the big challenges that countries like Canada and the US are going to confront over the next 10 years. And it's not just the interplay between housing and migration. Housing affordability facilitates the movement of workers, even within, not migrants, not international migrants, but domestic migrants, within different regions of Canada in search of opportunities, or the US for that matter. Housing is one of the major components of or investments of households where their wealth lies. So it's actually one of the key drivers, housing appreciation, of the increase in wealth inequality in North America, and not just in North America. So a lot of the challenges that we face are very much tied to housing. And the key question is, if Canada or the US want to continue attracting all that talent, all those migrants, to boost their economy, housing affordability must be central to the agenda. If they want to tackle problems of income inequality or wealth inequality, housing must be central to the agenda. And that requires that the authorities think broadly about not just the demand side. After all, as a central banker, I have to tell you that the role of the central bank is very important through its impact on interest rates. But it's not, the central bank is not, or does not have the tools to solve some of the deeper problems that have made housing unaffordable. The other thing I want to say, if you allow me to,
of course,
is we've talked a lot about bubbles, and I think credit is due to central bankers and policymakers more generally for having been a lot more willing to argue and make the case that the overheating in the housing market was just not just a fundamental story, but was a bubble. In the case of the United States, Chairman Powell, in a recent event, maybe a month ago or so, at the Brookings Institute, he was asked point blank by one of the members of the audience what he thought about the housing market in the U.S., and he defined it during the pandemic as a bubble. So that change of mindset in terms of policymakers and the efforts that many scholars and researchers are making to try to bring evidence-based standards to judge the behavior of the market, which is in part what we are trying to do here at the Dallas Fed, is or can be very important to help shape those expectations and hopefully to bring evidence to bear about the risks of a bubble. And in fact, one of the things that I did not mention before, but I should mention now, is that one of the things that we can take some solace is that although very intense during the pandemic, this episode has been a lot shorter than the pre-2008 housing boom in the US in particular. And one of the obvious implications of that is that the shorter the episode, the smaller the misalignment and the potential correction because of the frothiness of the market that might ensue. So that's one of the key advantages. We should not just among policymakers, but more broadly, try to look for more evidence-based assessments of the housing market that might help us dispel some of these manias and potentially panics too that can happen when the bust starts to unfold. That might actually make, over the long term, the housing market more stable. And if that's one of the things that, or one of the lessons that we've derived from the previous crisis, that you don't have to wait for a bubble to bust to even start thinking about it, will make a significant progress. Because at the end of the day, expectations are fundamental for what happens in the housing market. And we need to increasingly shape them on the basis of evidence.
Yeah, and I think, getting back to the value proposition that a place like Canada or many of the Commonwealth countries can offer to people who want to immigrate is sort of that very middle-class society, which has been divided by asset inflation, like you described. Like, you're almost looking at what some people might describe as a K-shaped recovery on the other side of the pandemic, and really driven by the housing asset in the Commonwealth for sure. Enrique, I really want to say thank you for your time, and I want to be mindful of your time as well. If there isn't anything else that you'd like to add to the conversation, I'd love to let you go, but also maybe try and get a commitment from you to revisit this sometime over the next 12 months, because I really enjoyed this conversation. I think it'll create a lot of value for our audience, and I'd love to resume the discussion as things start to look a little bit different for the U.S. and for Canada in the housing market.
It was a pleasure chatting with you, Daniel, and I very much look forward to us continuing this conversation. For us, one of the things that is fundamental is to contribute to the public discourse, and as part of our outreach efforts, we would like to facilitate information and content that can help not just policymakers, but just your average Joe think some of these big issues. So if I can contribute to that with these conversations, I'll be very much happy to do so.
Thank you. Amazing. Really appreciate your time.
Thank you. You too. Bye-bye.